Indexing and passive investing are two sides of the same coin. Let's break down how this strategy works for your portfolio. An index is simply a list of stocks or bonds that represents a specific market, like the S&P 500. By holding a broad basket of assets, you capture the overall growth of the market instead of trying to beat it. Passive investing is popular because it keeps costs low and removes the stress of trying to time the market. Active managers try to pick winning stocks, while passive investors accept the market return for a much lower cost. Over decades, that difference in fees can significantly impact the final amount of money in your retirement account. This famous philosophy from the founder of Index investing highlights exactly why simplicity often wins in the long run. Passive indexing is a long-term strategy for many retail investors. Educational content, not financial advice. See you in the next video.